Now let's talk a little bit about market risk. Now, if you look historically in the US stock market history for the past 100 years from Ibbotson, we can see that small stocks and large stocks have earned anywhere from 10 to 12% a year. So over the long term, I would say that's a very fair expectation of your rate of return. But what about the short term? This is the same chart that looks at a smaller time window from the year of 2000 to 2012. During this period of time, we had two very bad stock market recessions. One was during 2000 and 2001, and the other was during 2008. And during these two periods of time, both times the stock market lost 50%. Imagine at the beginning of 2000, you had $10,000 invested and saved. Now your $10,000 lost 50%. It took you another 3 to 4 years for you to recoup that loss to break even. Great. But the problem was in 2008, we had the housing market recession that occurred. Boom, another 56% in the negative. And it took you another 3 to 4 years to break even at that point in time. And that's why in the financial industry, we call this window of time the lost decade, because a lot of people lost time and money. Imagine this happened to your money. Can you really afford to lose 6, 10, 12 years of your time to try to recoup the losses from the stock market? And that's why when we're working with families, we educate them on all the different types of investment strategies. You see, somebody can put their money in the bank, earn 1% a year. They won't lose anything, but they won't gain a lot. It's a fixed rate of return. They can put their money in variable investments that go up and down with the stock market. When the market is doing good, great, we're gonna make a lot of money. When the market goes down, that's not so great. And if we lose, let's say 40, 50%, we actually need to earn a lot more than what we lost to be able to break even. But there's a third category of investment that 80 to 90% of people don't know exist. And these are what we call index investments, not to be confused with index mutual funds. Index investments, what they do is they link your rate of return to a stock market index. Think the S&P 500. As the S&P 500 grows over time, our clients' money would be earning upwards up to a cap or participation rate. So if the index grows maybe let's say 15%, our clients might get 12 or 13%. They're going to be capped in their growth. But because they have a cap on their growth, when the stock market goes down, our clients enjoy complete downside protection against loss. They don't lose anything. So when the market goes down, zero is the hero. And that's why when we're working with clients, I always tell them that these types of investments have been around for the past 10, 15, 20 years. The question is, have we heard about them? Have we looked into them to determine whether or not our current financial portfolios are best optimized for our financial independence and our goals?